Hello, it's Jonathan Wellham of Rocklinc Investment Partners, and we are ready to start our March 11th webcast. We've entitled this Rising Yields. So as we move through the presentation, which also you can click on and have access on below the video, we'll start the presentation now. So the first slide, which we always put up, is the slide that has to deal with our disclaimer. And so I just encourage you to have a quick look at that disclaimer, and you can read that at your leisure. In terms of the overall view of the presentation, the next slide will just give you an outline of the presentation that we're planning on going through here. First of all, just a quick word about Rocklinc. The next one will be our investment challenges, market developments, current events, positioning, how we're positioning in this market. And then we will zero in on a couple of areas where we're investing. We're going to talk a little bit about OpenText, a new company that we've been slowly populating it in some of our client portfolios, and also the infrastructure area, and then a time for some Q&A at the end. So very quickly, as we always talk about when we do these presentations, just a quick overview in terms of Rocklinc. We are pushing close to $200 million in assets. We have about 190 families, and we focus on customized portfolios. And you can read the other information there, again, at your leisure. In terms of our investment philosophy, it's always important to talk about the very bedrock of what we do and how we approach investing. And as our clients know, we look at look for excellent companies, high returns on equity, all the different things that you would want to find in companies if you're taking long-term positions. We focus our portfolio, so this really differentiates us from the masses. We're only looking for 20 to 30 stocks. Those stocks have to be exceptional companies. We do not want to be everywhere in the marketplace. And then our investment philosophy does lead to tax-deferred compounding, which means tax efficiency and open accounts. And we're very sensitive to the prices that we're paying and so on. So that's just a quick overview in terms of our investment philosophy. It's about quality, about understanding, and being very disciplined in terms of what we're buying. Now, the investment challenges which we continue to talk to our clients about only get more interesting and probably only more challenging every day and every week and every month that go by. The global debt levels are completely out of control, and we'll have a talk briefly about that again today. Unfunded government promises. Our governments love to tell us that they're going to look after us in the future with our own money, of course, and those promises are becoming a little long on the tooth. Demographics. The aging population continues to be a serious problem, and the COVID situation last year, the 2020 and the lockdowns and so forth, that didn't lead to any increase in birth. It actually led to a plummeting of the birth rates throughout most of the industrialized world. And that's, again, going to be a problem if you don't have children coming along to pick up the tab that we're very generously passing on to them. In terms of monetary policies, as we've talked about before, our central banks continue to print money at just insane and record levels. I'll talk a bit about that. In the low interest rate environments, which we are seeing interest rates trying to come up a little bit, they're trying to poke their heads up. And then as we've talked about before, and I'm not going to get into today, the whole lockdown folly, this idea that you can just shut down the private sector and large portions of your economy and replace it with printed money and public debt. It's probably been the most devastating economic, self-imposed decision that's ever been made in the history of mankind. And we still have not seen really the impacts of that in the economy, which will take some time to run through, and we don't think it's going to be pretty over the long term. Now, in terms of the market developments, just let me go through these quickly. First of all, stock market valuations are high, so we need to be very careful. Now, that's not true of every sector, but overall, the valuations are high in any kind of traditional valuation measure. The central banks, as we've talked about again previously, continue to print money at record rates. In the U.S., their stated objective is about $120 billion a month. In fact, in February, the numbers I've seen, it looks like they added about 180 billion. In Canada, our central bank continues to add 5 billion plus a week, which is about 20 billion a month. And we've seen that the debt levels are not really slowing down that much. Governments continue to run massive deficits. And so the debt overall is continuing to increase really unabated. And this is concerning as long-term investors. And then we're seeing rapidly rising yields just in the last 6 weeks. And so the question we have, of course, is how high can they really go? And we'll have some slides. I'll talk about this throughout the presentation. We firmly believe that given the debt is so high and people's indebtedness is so high, it's going to be very difficult for interest rates to go up much more. Yeah, we could add another 50 basis points, 0.5% or so, but if rates started to poke up to 3%, 3.5%, 4%, it would really damage our economy. And we would be back into a recession or even a depression if rates went up a lot given the debt level. So from our perspective, we're sticking with investments that will do quite well in a lower rate environment, and businesses that are very robust. Even if rates do go up, they certainly will be able to weather that storm. In terms of other market developments, we've seen downward pressure more recently in the high-flying technology stocks. The technology index in the United States was down about 12-13% from its high. It's now started to pop back up again the last couple of days, but we've seen again as interest rates come up, it puts pressure on the technology stocks. We've seen precious metals really reached a peak in August, and they've been just slowly on the pressured down. And more recently, we've seen them drop a fair bit because in an increasing interest rate environment, it puts tremendous pressure in the short run on precious metals. This does not deter us in the least, because when we look at the underlying economic fundamentals and the increasing amount of fiat currency that is being pumped into the system, we want to own precious metals even more, given those fundamentals. So the fact that there's some volatility on the downside only provides greater opportunities for investors. Downward pressure also on high dividend stocks. Whenever interest rates again come up, it puts pressure on securities that are being valued off of their dividend. And again, this is a transitory situation. We don't believe this is going to be a long-term issue for infrastructure companies, utilities, or real estate companies. Providing they're well financed, providing they continue to grow, it'll be no problem in terms of our holdings. So the fact that there's been weakness in that area, again, does not deter us. Rates can't go up very much without causing other problems in the economy. And the kind of companies that we own, an increasing interest rate will not disturb their strong balance sheets and their funding costs going forward in any material way. And then there's more cyclical stocks are moving up, and we're looking at some of those areas. We'll probably pick off a few businesses and opportunities where we can find a business that is sort of falls into this category, more cyclical, but it's an exceptional long-term company. And what I do point out on the slide, you'll see that a lot of people are saying, okay, we got vaccines and we're going to go back to back to normal. Our view is that the problem with going back to normal is we've got this massive debt burden. And so getting back to normal and normal interest rates is going to be tricky. It's going to be a little more difficult. And not because of COVID and not because of this flu bug, but because of the massive indebtedness that we have incurred, and some of the other issues I'm going to talk about just on this next slide here. Because part of this new normal, if you will, is that we now have what we call structural deficits. And what I mean by structural deficits is that governments have so overextended their reach. What I mean by structural deficits is their spending, that it's going to be virtually impossible unless there's an external force on governments to balance budget. And so almost the norm is a large deficit. And people are used to this. And this is going to be very difficult to get out of. We've got a real addiction. The second point I have there is central banks are addicted to money printing. And boy, are they ever addicted to it. This is a narcotic that they cannot get away from because of this, the level of debt. They've got to continue to support the market. So that, again, concerns us when it comes to eroding the value of our investments with so much new money going into the system. The third point there is citizens seem oblivious of the precarious financial position that many of our nations are in. If you talk to the average Canadian, they just don't seem to have a clue of what's going on. In fact, there was just a study done, I guess it was yesterday I was reading, Nanos REIT study saying that a third of Canadians would trust the current government in Ottawa to extricate us from our financial problems, although they're the ones that created it. And so when you see that, you realize that there's really isn't the pressure on government to solve these problems yet. And so we need to be very defensive and very careful, because this could go on for a little while and it could hurt investments. And then economists keep dreaming up new theories to justify the printing of money and also the deficits. We won't go into details here, but modern monetary theory, we've talked about this before. This is a crazy theory that basically says deficits don't matter. You can print money, and governments will be very responsible in how they do this. And so if you believe that, then you just pound into the market and buy everything. We don't believe that. And history has told us that governments cannot be trusted. And some of these theories go against basic economics, and they will not work out over the long term, even if they are perceived to work in short periods of time. And so we think we must go through another really upheaval in the marketplace, some tough times, if we're ever going to get back to anything normal. And so in the meantime, we have to be very careful where we're investing. Just a couple of quick slides here that I can talk to, just to emphasize what I've really sort of told you verbally. Let me just look at some graphics here. First of all, the debt. This is global debt. It's total debt. Back in 1999, it was 70, 80 trillion, and we're now pushing 280 trillion now. That growth is astounding. It's over double what the economies have been growing at. So the debt level is disproportionate in terms of growth. This chart is very fascinating. This is the money that's been printed by the Federal Reserve in the United States. And this is important because the Federal Reserve is the key central bank in terms of the world economy. And that blue line that you see there, that's the money supply. And you can see that back 2008 was actually about 800 billion. And you can see that money supply now has just skyrocketed. And you can see where, if you go back to 2020, just, a year ago, you can see that large uptick right at the end of the chart. That's the money that was pumped into the system in order to back up all the lockdowns, in order to support the economy. And so now you've got, 7 trillion plus in new money that's been added to the system. And the important thing to note there is right up until last month, they're adding money. You can see that blue line continues to chug up. And despite all that money that's been pumped in, they still have to add more. And that's telling you that we need to be very careful. If it was a healthy rebound, then that money could be pulled out. But as you can see, if you go back over time, that money is needed and it stays in the system. It's very difficult for the Fed to pull any of that money out. So very quickly here, just gives you a sense, using the US as an example. I find this chart just astounding. So if you go back to 2008, 2009, you think of the great, financial crisis we had starting in the housing market and the indebtedness that ran across the whole world, the great financial crisis. The United States had stimulus and support of about 1.8 trillion. And that was a big, big problem. So then you fast forward to 2020 and you go, here's a flu bug that hits us, and we self-impose a lockdown. And here's how much money we've needed to pump into the system: 6.1 trillion so far in the United States. I should correct my terminology. We probably didn't need that, but that's what's been added. Because when you look at the bills, the latest one, the 1.9 trillion, which is the block on top there, I think they said only about 9 or 10% of it was actually COVID related. The rest of it is just pork that goes into different constituencies based upon the seniority and the weight that the Congress people and the senators have for their various jurisdictions. Having said all of that, the point is, when you look at the abuse of the financial balance sheet in the United States, it's shocking. And again, this will come back to haunt us in terms of the future. In Canada, we had this slide up the last time. I couldn't get the update on it, but and when you look at the Canadian situation, let's not be mean to the Americans. We've been even worse in terms of the increase of debt as a percentage of our GDP. In 3 quarters, the first 3 quarters of 2020, and this has only gotten worse as we've gone forward, we increased our debt as a percentage of GDP across all the different constituents in Canada by 80%. I mean, you really have to think about that number. It's massive. And that's the worst in the world. And you can see the other comparisons that you can look at your leisure. The financial recklessness of our leaders has been unparalleled. Let's put it that way. And I think I'm probably being kind. If you look at Canada's situation also, when you look at our total debt to GDP and compare it to other countries, this includes personal debt also, which is very high in Canada. You can see that we're second worst in the world. Canada's sitting at about 352.6% debt to GDP, just behind Japan. In fact, we're even ahead of our friends in Greece. And if you might remember, a few years ago, Greece was being condemned for being irresponsible in terms of their debt position. So I'm not sure what that says about us here in Canada. What's interesting is this next slide here. A friend of mine passed it along to me. And if you see all that debt, where is it going in Canada? And I think, this video is going out mostly to Canadians. I think you probably know exactly where it's going, especially on the personal side. It's going into real estate. Everybody's pumping up the value of real estate in just a crazy way. And if you look at the real estate as a percentage of GDP in Canada versus the United States, we're running pretty close to twice the weight, twice the value GDP in terms of real estate to GDP, which is not healthy at all and not sustainable, because housing markets really are not the best way to drive productivity for an economy. You need to put that into infrastructure, productive assets, not homes. It's great to have homes, but if they become really the driving force of an economy, that economy is not going to be growing very quickly in the future. And so this is, again, something you want to be concerned about, and we are as investors also, as we look at investment opportunities. And then just quickly, just as I finish up my section here, if you look at, remember, our whole thesis is interest rates really cannot go up very much without major economic troubles. So yes, they've been rising, but there's going to be a lot of headwinds, and therefore we're not going to invest based upon interest rates going to 5 or 6%. That would crash the economy. So I just have a couple slides here just to give you a sense of the interest costs currently to fund our current debt in this country. So just if you look at this chart here, if you go down to Ontario, which is BC, Alberta, Saskatchewan, Manitoba, and Ontario, you can see that the interest cost currently on Ontario's debt, which is close to $400 billion and almost half our GDP, is about $12.5 billion. And that's about 8%, a little over 8% of our whole budget in Ontario. So if interest costs were to go up to double, and remember that $12.5 billion is based upon about a 2% interest cost. So we're rock bottom on interest, and it's still sucking up, over 8% of our budget. If interest costs were to go up by another 100, 150, 200 basis points, that interest cost basically could start to approach, 16, 17, 18% of our revenue, which would be crazy. And so you can see that governments cannot afford to have any interest rates go up because they are so indebted. And that's the same with Canadians in general. This chart here looks at the total interest that was paid by all the governments in Canada. It's about 67.8 billion. You can see that there. And just to give you a sense, that number, and remember, we're at rock bottom interest rates. We're at interest rates that are right at the bottom. And yet that's equal to what we're paying out in all the pension benefits for CPP and for the Quebec pension plan, and fairly similar to what we spend for all of our education spending from kindergarten and pre-kindergarten all through grade 12, just to give you a sense on how large that is. Now, what happens if that interest cost were to double, which would mean really just a couple of percentage points of interest increase? It would be abhorrent and shocking. And just a quick note here, if you look at the Ontario situation, our Ontario portion of our debt is about 12.5 billion, as we saw on a previous slide. That's more than all the money we pump into post-secondary education, and it's pretty similar to what we put into our whole infrastructure costs here in Ontario. And you can see here, we are stretched, and not just Ontario, Canada, United States, Europe, all the Western worlds are so stretched, and they cannot afford to have interest rates. In fact, the European Central Bank just released their little report this morning, and they're now buying more debt within Europe, and they're trying to keep the interest rates down as much as possible. And in many of the European countries, the interest rates are still negative, and they can't even afford to have a positive interest rate, if you can believe it. So these are not just Canadian or American issues; these are global issues. And then this last slide I have here, it just shows that in the last 6 weeks we've had a large uptick in the bond yields. And if you look, we'll just focus on the red line, because that's in the Canadian market. We started the year at 67 basis points, or 0.67%. And we've shot now above 1.5%. It's come off just a little bit the last day or two, but you can see that's a huge rise in yields on the 10-year. So our whole thesis when it comes to investing is, are we preparing for a 3%, 4% 10-year yield? Not really. I mean, we have businesses that would be able to survive that, but we don't anticipate that happening because it would crush our economy. It would absolutely crush the economy. We think that central banks will step in and they'll manipulate things more until things get until they hold the rates down. Otherwise, we'll be in serious trouble. And one of the reasons why we do own gold and silver and the precious metals and hard assets is when that does break, when the central banks maybe lose control at some point, then we're in the kind of assets that will maintain long-term value and protect our clients and for the long term. So with in terms of our positioning then, as we said, low exposure in financial institutions. We're concerned about credit markets, focus on consumer staples, maintain our position in precious metals, and actually been picking away and adding a little bit more. We love the attractive values there. And maintain significant global investments, invest in essential businesses, maintain healthy cash balances, and we're patient. I put this down here. We have no FOMO. You'll see that if you're reading the papers. And what that stands for is fear of missing out. I just want to point that out to people. We're not going to chase stocks. We're not going to pay ridiculous valuations for them. Fear of missing out is not something that we want to be driven by. That's really just another term for greed. And we want to be very disciplined when it comes to our purchasing of assets. And then we've just given a quick update in terms of our performance summary, in terms of the Rocklinc. And because of the precious metals and some of the interest sensitive stocks, we've come back just a little bit in the last 3 months. But over the last year, we've been pounding away there at over 12%. In the last 10 years, over 10%. And this is across our book of business, which is a balanced book. That would be about 70% equities, 30% bonds. And then on the pure equity side, over the last year, we're up about 20%, 20.9%. This would be February to February. And over the last 5 years, we've been averaging about 15.5, and 10 years, 12.1%. So the only thing that sort of held us back in the last couple of months has just really been sort of precious metals in one area, because they've come back a little bit. And then some of the interest sensitive stocks, some of the dividend stocks, but they've actually been roaring back the last couple of days. And we have no fears. Those are the kind of businesses we want to own, and they will protect our clients over the long term. And we won't worry about short-term transitional moves in the marketplace as they rotate into different areas. So with that, I'm going to hand it over to Andrew to talk about open text.
So thanks, Jonathan. So OpenText is a company that we have been slowly deploying capital to an individual portfolio. Data and information have become some of the most important assets in a data-driven economy. Every day, organizations accumulate and process and create never-ending amounts of data and information. As data mounts, organizations are challenged with synchronizing data across disparate systems and sources while trying to extract meaningful insight from this data. This can have implications on maintaining industry compliance regulations, data privacy, data processing, and securely exchanging data between systems. Data integration and data management is critical to the operation of a company. One company that has been helping to solve such complex problems is a company right in our own backyard, actually a Waterloo-based company called OpenText. OpenText is one of the largest software companies in Canada. It offers a powerful enterprise information management platform that is used across the entire information lifecycle. It is used to integrate data across disparate systems by breaking down information silos so that organizations can better organize, understand, analyze, and use their data and information more efficiently and effectively across the organization. OpenText Business Network allows for secure data exchange across complex networks through a single platform. And that's very important as large organizations have multiple different systems generating significant amount of data. It is very important that organizations are able to aggregate, integrate, interface multiple different data sources into one single platform so that they're able to effectively use their information to be able to pull important insights of their customers or their business process. For example, supply chains rely on OpenText for secure data exchange across information, across different trading partners. And you can imagine just the importance of that, just the amount of different vendors that organizations must be able to manage their data. Having a single source of truth is very important just for managing just the day-to-day complexities of just such a significant amount of data. OpenText also allows organizations to manage supply chain business processes from order management to managing inventory levels while maintaining country compliance requirements. And OpenText has significantly grown over the years. It works with over 10,000 global customers. Many of its customers have revenues over $2 billion. Now, those are large organizations. OpenText works across diverse industries, so from financial, consumer goods, services, technology, public sector, healthcare, basic materials, conglomerates, industrial goods, utilities, a wide variety of different types of industries that OpenText provides their information solutions. It also provides advanced technologies such as AI, machine learning, data analytics to help automate data processes and be able to draw out important insights and improve decision making. Cybersecurity is one important area that many organizations are increasingly pouring in capital. As you see in the news, if it's not every day, it's every other day, that there is almost seems like there's some sort of ransomware attack affecting companies, holding organizations, large organizations hostage. And so since OpenText is a data-driven information platform, cybersecurity is just paramount. And so it has multiple layers of defense to detect, protect, and forensically investigate and remediate threats of data loss or malware attacks. And so OpenText, they have strong partnerships with leading companies such as Microsoft, Amazon Web Services, Oracle, Salesforce.com, and SAP that allows OpenText customers to use OpenText solutions across other technology platforms. On the next slide, I'm just going to walk through just OpenText's very simple three-pronged strategy for growth. The first prong or the first pillar is a retain. So OpenText has a large user base of over 100 million end users that use OpenText to digitize and manage their critical information. OpenText continually develops innovation solutions to address its clients' most pressing business problems, which is probably why it has a high renewal rate in the mid 90%. That's quite high. The next pillar is growth. So OpenText is focused on organic growth. Organic growth opportunities by developing new solutions. Each year, the company spends about 11 to 13% of its revenue on R&D. Over the past 3 years, fiscal years, OpenText has invested a cumulative $1 billion in R&D. One of the big bets, one of the critical areas that it has been investing in is the cloud. So cloud is one of the primary areas it's committed to and helping its organizations, customers modernize their technology infrastructure. Another area of growth is expanding their geographic footprint. North America companies are not the only companies that face struggles with managing their information. There are global companies across the Atlantic and Pacific that require systems like OpenText to be able to manage their information effectively. So that's another area of growth that they can employ. And then thirdly, acquire. So OpenText makes strategic acquisitions to deepen, to strengthen its existing portfolio, while at the same time broadening into new areas, new technology that is disruptive and important to organizations' growth. The company has $1.5 billion in dry powder, while it's been able to lowering their net leverage ratio. It's been able to lower it down to 1.6 times, primarily due to strong capital discipline. So this gives the company greater flexibility to be able to make strong and strategic tuck-in acquisitions to help further grow its company. On the last earnings call, management mentioned that they have a strong pipeline and that they will deploy their capital as opportunities arise. Over the past 10 fiscal years, the company has deployed $6.8 billion on acquisitions. One of the areas of focus has been cloud-based providers. In fact, the company has acquired 9 cloud-based companies since 2012. OpenText has been developing, through acquisitions, a secure and scalable infrastructure while investing in their own data centers and partnering with other cloud providers such as Amazon Web Services, Microsoft Azure, and Google Cloud. So this is a very simple but proven business model that OpenText has used again and again to become one of the largest software companies in Canada. Now on the next slide, I'll go over our investment thesis as to why we believe that OpenText is an attractive long-term investment in our client portfolios. So we believe OpenText has all the right ingredients for growth. OpenText is a market leader in growing enterprise information management market. Data and information are not going away. They're important assets of an organization that is only going to continue to increase. There's no slowing down in the amount of information and data that organizations are creating on a daily basis. Companies will need enterprise information management solutions to manage and secure and effectively use their data. OpenText has a sticky customer base with a 94% renewal rate for non-cloud customers and a mid 90% renewal rate for enterprise cloud customers. This just shows just how important OpenText has been in their clients' business process, and clients just rely on OpenText for their products and services. You've probably heard time in and time again that we like companies that have predictable and stable business models. And OpenText has a 78% annual recurring revenue. This is a common attribute that we like. We like market leaders with strong economic moats that have a long runway for growth that can benefit from the power of compounding. That is an excellent recipe for outstanding shareholder returns. Another reason why we like OpenText is that it has strong partnerships. It has strong partnerships with leading technology companies such as SAP, Google Cloud, Microsoft, Amazon Web Services, Oracle, Salesforce.com. Working with these very innovative organizations help OpenText create new generation information solutions to benefit their customers. OpenText solutions are deployed across their partners' platforms, and that actually gives their customers scale and to growth and for the ability to tap into these large technology companies for cross-selling opportunities. OpenText is making strategic investments in disruptive high-growth areas. and accretive acquisitions. So OpenText is investing in AI and analytics to help clients analyze big data, automate processes, create predictive models, and extract as much value from information. This is all translated into strong historical financial performance. So, for example, one metric that we like to look at is the growth of free cash flow. Free cash flow is simply the amount of cash that a business can generate after paying its expenses and capital expenditures to support its operations and assets. Over the course of fiscal year 2011 to fiscal year 2020, free cash flow has increased each year of over 18%. Over 18%, that's quite high. Cloud services and subscription businesses revenue has grown at a compound annual growth rate over 20% from fiscal year 2014 to fiscal year 2020. So you see a technology company that has this high rate of growth, you would expect that, boy, this must be trading at extremely high valuations. But in fact, this company is trading at very attractive valuations. It's trading at 12-month free cash flow yield is over 8%. Now, 8% in light of such growth areas and its market leadership, we believe that this company is relatively undervalued relative to some of its technology peers. And because of the recent increase in interest rates on the 10-year, technology companies' stock performance have actually come off quite a bit. And so OpenText has gone along with that as well. So this company is even more attractive as it's got a bit of a break on valuation. So we believe, in light of the economics, in light of the just the different areas of growth that this company has been entering into, we believe it's a very attractive company. So we've been slowly, as Jonathan mentioned, we've been slowly adding this into client portfolios over time. And so we believe this name will be a company that will have a long track record of growth over time and will be a profitable long-term investment in our clients' portfolios. So now I'm just going to hand over the presentation to Jesse, who's just going to walk through some of our core infrastructure companies in our clients' portfolio.
Thank you, Andrew. When we sit down as an investment committee and go over a business, what are the key characteristics that we look for? There's a long list that we look for, but I'll just list 4. The first one is economies of scale, high barriers to entry, strong recurring revenue, and strong pricing power. These are 4 examples of characteristics that we look for. Infrastructure assets, or real or hard assets, tend to embody all these characteristics. They're critical, they're essential for the global economy to function, and we tend to favor them. Some in client portfolios, which you'll recognize, is Brookfield Infrastructure, American Tower, Brookfield Renewable, Enbridge, Northland Power. These are all great, high-quality infrastructure companies. Infrastructure companies tend to lend themselves to be natural monopolies. So, for example, you won't have a hydro dam on this right next to another one on the same river system. Great businesses tend to be monopolies, oligopolies, or tend to manifest those same characteristics. When we on the next slide, I always encourage clients to realize that the stocks that they hold, they aren't just tickers on a screen that move up and down. These are real businesses. Management teams are actively involved in making operations efficient. They prune their portfolio. You own real assets, not just a ticker on a screen. So, for example, last March, when the economy was hitting real bumps in the road, markets were diving. Ports, for example, shipping ports, which through Brookfield, you own several around the world. In only a few months, they have seen record volumes. With regards to cellular data, you've been using your phone the whole time. Through American Tower, you own all the cell towers. Data is still growing at 30 to 40%, even in the past 12 months. So it's great to visualize the assets you own, and it's good to divorce yourself sometimes from market volatility when it's extreme, and realize that the underlying businesses and assets you own are great businesses, and they tend to be much more stable than the market prices. I highlight that in the next slide, where I highlight three major businesses. For example, even Enbridge and TC Energy, which are involved in oil and natural gas pipelines. In March and April of last year, we saw oil do something that we've never seen before. It hit negative $40 a barrel. If you looked at during that time and looked at the oil and gas environment, you would have these extreme moves in the market. You would have to only hindsight do you realize how stable these businesses were. So Enbridge, for example, if we look at their EBITDA, which is just a proxy for cash flow, an accounting term, but if you look at their cash flow, it increased 3% in 2020. And that was in a year where oil had massive swings. TC Energy, which is in the same business, oil and natural gas pipelines, it held flat, which is remarkable in the year of 2020. Brookfield Infrastructure, it actually grew in 2020. It's essential assets all over the world. They're global. I encourage clients to just go on their websites, understand which assets they own. They're in multiple countries. They were able to grow 6% and deployed $2.5 billion into new investments. So they were growing. They were acquiring and pruning their portfolio. And then American Tower, which owns a lot of the cell towers. No surprise that they're able to grow double digits. Our cellular use is way up. It continues to grow strongly, 30 to 40% over the past 5 years, every year. So I encourage clients to realize that they own actual businesses. These businesses tend to be more stable than what you can see in the market most often. And thankfully, you also don't own an index of these businesses. So for example, renewable power has been on a tear, and we own a lot of renewable power companies, but we're not forced to buy these renewable power companies at very high valuations. They have come off, just like Jonathan mentioned, we have seen yields creep higher. So they have come off. But the great thing is we're able to look at all these infrastructure companies and cherry pick the very best companies at the very best valuations. So we like these infrastructure assets. As we talked about, there's massive indebtedness through governments and corporates all over the world. As time drags on, we'll see more and more infrastructure assets come into the public markets, and great infrastructure companies such as Brookfield Infrastructure, Enbridge, American Tower, they're able to continue to grow and compound your capital. I'll hand it over back to Jonathan for concluding remarks.
Great. Thank you very much, Jesse and Andrew. And just a couple of concluding comments from my end. We did have some questions come in. So let me just very quickly talk about a couple of those questions. Some of the clients are saying, are you seeing inflation? What's your view on inflation? And of course, making macroeconomic predictions is tricky. But when we look at the money that's been pumped into the system and all of the indebtedness and the money that's on the sidelines, as we do hopefully open up our economies and these lockdowns are eased, which we are seeing in many jurisdictions in the world, we would not be surprised by an uptick, if you will, in inflation. I think our greatest concern looking forward would be more of a stagflation situation where we've got increasing prices, but not a lot of economic growth. Yes, we'll see some economic growth vis-a-vis last year, of course, but when you look at the underlying baseline of economic growth, it's going to be tougher and tougher because we've misallocated such a massive amount of capital into debt. And so our concern would be more of a stagflation issue. In terms of mortgage rates, we've seen mortgage rates edge up. But back to my original comment, as long as the central banks can keep rates down, they'll let them go up a bit just to settle. But if they really were started to spike up, as we saw in Europe, our feeling is the central banks would probably step in and try to do some yield curve control. as long as they can. I mean, at some point they're going to lose control of this, but for as long as they can continue doing that, we think they probably will. And so that makes us, again, very cautious, and why we're focused on growing companies. And when we are focused on dividend paying companies, we're looking at the value, and we're looking at companies that have the best cost of capital, so they'll be least impacted by interest rates as they're moving around in the marketplace. As Andrew pointed out with OpenText too, when you're talking about a company that's growing, but also very attractively priced, as he pointed out, 8% free cash flow yield. Most technology companies are trading 2%, 2.5% free cash flow yield, maybe 3 in some cases. And so when you're looking at a company at 8%, my goodness, what a wonderful opportunity to pick away at a stock like that. So our view going forward, hopefully we've been able to elucidate some of our thoughts and pass those on to you. We stay committed to the core areas that we've been investing in. We are not detached from those areas. We continue to evolve the portfolios, take advantage of the swings in the marketplace. We love markets that go up and down. That provides us great opportunities, and we'll stay focused in terms of the portfolios going forward. So that's the update we wanted to pass along to you, and we really appreciate your support. Look forward to the next webcast, which officially is scheduled for June the 10th. And Lord willing, we'll be back in front of you then and giving you an update at that point in time. So thank you very much for your support, and look forward to speaking to you in 3 months' time. Bye now.